All right, thanks for coming. So today I'm going to talk about, I think the original title was The Economics, and then once I started to think about it, I thought, well, no, let's just do some economics because it's such a huge field to talk about. So what I'm going to take you through, we were discussing how we would do this, and one idea originally was to just do a little sort of session on game theory, but then that was a bit sort of dry, I think, and we decided, well, let's do something on where it's more applied. And so this is a mix of some ideas that you often see in the literature on takeovers and mergers and acquisitions, but with a little bit of strategic analysis along the way, just to give you a flavour of all of how these things are applied. And the interesting thing here is that ideas which you learn in your micro courses, externalities, think public goods, free riding, incomplete information, all of this stuff where you think, well, it's only really to do with taxes and subsidies and what the government's doing. It actually has a whole lot of implications for the way the private sector behaves. Okay, so we're going to see that in the talk, hopefully, and just give you an illustration of the power of economics to when you start thinking about some of these issues in corporate finance. So when you go and look at the literature on some of these issues, there's a lot of economic analysis in it. And really my appeal here is partly to colleagues, but also to people who are sort of teaching economics anywhere and thinking about it is, well, we always talk about policy implications, but economics is a lot broader than that. So we should start thinking about how economics can be applied just to private sector behaviour more generally, and how we can extend these ideas into thinking about these issues. So just some background. Already talked about, that's what I'm going to talk about today. So here's just some data. So this is from a merger market, just to give you some idea of the what's been happening in the merger and acquisition sort of activity in Australia over the last few years. So the dark blue lines are deals that have been done by value, and then the light grey line there is just the volume or number of deals. So you can see the first thing is that it's cyclical, right? It may not be purely pro-cyclical, but there is this idea that, which I won't really touch on today, that there is this idea that, well, merger and acquisition activity tends to have this pro-cyclical sort of component. And it's starting to pick up over in this area here, and there'll be a couple of articles that I'll talk about in a minute that try to get at that idea. But we had a big sort of wave here in financial year 2011, then just before the GFC, and then a lull during the GFC period, then started to pick up, and then another lull, and then people think, well, maybe it's starting to pick up again now. Value by industry, so this is just a breakdown by industry. So as you'd expect, in Australia, the biggest chunk is in energy and mining and utilities, but then most of it is taken up by other areas as well. So there's financial services, real estate, transportation, and then a whole lot of smaller areas as well. So it just gives you some idea of the breadth of what's been going on in 2013-14 by industry. So the outlook, so I just got a couple of articles here from the popular press. Now it depends who you talk to, obviously, about what the outlook looks like. You often talk to people and they say, yeah, well, things are just going to get better in this particular area. People will say, yes, we've got all these deals in place and they're all going to go well, and things are looking up. And it seems to be a bit like that. So whether these predictions come true remains to be seen. Here's an article in The Australian just from a few months ago that says, well, there's going to be all these deals that are going to happen over the next 12 months. Here's another one that says, yes, we're at a high now and the outlook is very strong. So that's just to give you some idea of the context at the moment. As I said, depends on who you talk to. People from Deloitte here may have different views about what's happening in the market. I guess we can talk about that later. But there is this view out there that things are starting to pick up in merger and acquisition activity in the Australian market. as I said, it is, does tend to be pro-cyclical a lot of the time, so a lot of that will depend on whether, what happens with the macroeconomic outlook more broadly. Okay, so some general economic issues first. So what are the motives for mergers and acquisitions and in this market for corporate control, as it's been termed? So there's a neoclassical view. So the neoclassical view just says, well, this is all part of what happens in markets where resources move from low value to high value uses, right? And so there's a lot of different ways in which, or a lot of different reasons why that might happen. So you might have economies of scale that you're taking advantage of. So now there's a huge fixed costs that we want to distribute across a single organisation. Let's try to merge with somebody to spread those fixed costs, so get some economies of scale. Or it could be some economies of scope that you're trying to take advantage of. So economies of scope is where we're got a business and we might be vertically integrating, right? And economies of sequence as well. Right? Or the reverse that can happen in the case of divestitures. So there's talk at the moment, BHP is an interesting example where they're hiving off some poorly performing assets, and one reason for that could be just a purely cost thing, but it also could be there's been some change in the broader outlook that they're and then they're not taking advantage of these economies of scope or synergies that they did before. So people in the corporate finance literature talk a lot about synergies. In economics, we just think about that as just a positive externality. So we merge with another firm or we take over another firm, and the value of the thing that's joint is bigger than the value of the two things separately. So that could be because of economies of scale, or it could just be that we just work better together. So just the managers and the workers in the two businesses just like each other and have a better fit. And so there's some positive externalities there. Or it could be, the capital in one firm works really well with the labour in another firm, so it could be sort of cross-factor positive externalities that are happening there. Another reason could be transactions costs. So if you think about the Coase theory of the firm, so Coase in 1937 came up with this idea that, well, the boundaries of the firm is really determined by the extent to which the transactions costs of doing things within the business is less than the costs of going to the market, right? And so that's a thing that's changing all the time. And so it could be that, well, by fully vertically integrating or fully integrating with another business, that's better than some sort of arm's length transaction or some sort of quasi-vertical integration where we have a long-term contract. Or it could be, well, we just, one company's got a better set of managers than the other, and they decide, well, we're just going to come in and kick the other lot out, and we're going to be able to improve efficiency within the company. Another reason could be growth. So it could be that we want to merge with a company that's got access to overseas markets and we don't, and so we'd like to get that access to boost revenue. Or there could be some sort of risk diversification issue for shareholders where we're acquiring a company where its risk profile looks different from ours, and that provides benefits to shareholders. So in all of those things, there's this idea that, well, we're moving from a situation which is somehow less efficient, indeed in a private sense, but also in a more broadly, social welfare sense, that we're getting these efficiency improvements. There are some other views. So one possible reason, which would be known to competition policy experts, is, well, it could just be we want to eliminate our competitor and take advantage of some market power. Right? So we go from 3 to 2, 2 to 1, when we can eliminate the competitor, increase price, reduce quantity, and increase profits that way. So that can work either if you're a seller or if you're a buyer. So you might be trying to merge with a company that now you want to have superior buying power in the market that you're in rather than selling power. Could be reasons, debt equity sort of reasons. Won't talk too much about that. Some other reasons are, well, the market's just wrong. So we just want to acquire this company just because its share price is low and we think it's actually just got a higher value, and so it's just a pure sort of arbitrage speculation opportunity there, and we're just going to do that because we think that the market price of the shares is too low. Or there's other explanations, so it could just be, there's this managerial slack and the managers of one firm are looking to capture the free cash flow of another firm, increase their executive compensation, which can often happen after a takeover or merger. Managerial discipline, which is one I'll talk about in a moment. So that's this idea that the possibility of having a takeover places pressure on existing managers to actually behave well. So I'll talk a little bit about that. So it is a sort of efficiency reason, but it's not the case that the takeover actually improves efficiency. It's this outside option that forces the existing managers to behave in the interests of shareholders. And then there's other reasons. So one reason could be taxes, regulations, and other legal issues could induce firms to merge or to want to acquire another firm. Or there could be some sort of cross-border or globalisation motive where we just want a local presence in the country that we're selling to, and we can just acquire a domestic firm and get that toehold there. So this is not an exhaustive list by any means, but it's just some of the possible motives for why these things can happen. And what you notice is that economics pops up in almost all of these. So all of these issues around economies of scale, which economists think about all the time, positive externalities, transactions costs, risk diversification, all of these things economists think about all the time. So economists have a bit to say then about, at least about the motives and reasons for why we might see waves of mergers and acquisitions. So here's an example, takeovers as a disciplinary device. So the classic paper here is Sharfstein, and his argument is pretty simple. He says that, well, suppose we've got a situation, classic sort of principal-agent kind of setup where the principal is the shareholders and they want the manager to do something and they can't observe the manager's actions. All they can observe is the outcome of what's happening, of whether the shares are high or low. And so one reason for poor performance could be, well, just the environment that the company is operating in was poor, or it could be because the manager's shirking, not doing his job properly. Now, you can try to design a contract around that, but it's for reasons that explained in the economics of incomplete information to the literature, it's not going to be fully efficient just because you can't observe the true state of the world, and there's a trade-off there between getting the incentives right for the manager, but also getting the risk. He's going to be risk averse, and so you've got to give up something there. So one possible way that inefficiency of that contract can be mitigated is by the possibility of a takeover. So if a raider who has some better information than shareholders comes in, then Sharfstein says, well, that can actually improve matters. Now, so if the manager shirks and the raider knows that, well, there's some shirking going on there, shareholders don't know what's going on, they're willing to sell at a low price. The raider, however, knows that, well, if I take over, the value is going to be high. So in that situation, you've got a buyer who knows something about, well, the guy you've got in charge has been shirking, so if I take over, the value is going to be high. Shareholders just want to sell because they don't care, they just want to get out. And so a takeover, there's a likelihood that that will happen. Right? On the other hand, if it's just the environment that's unfavourable, well, shareholders will still sell at a low price, but now the raider knows, well, there's nothing I could really do here to improve the value, it's just the market, so I'm not going to bother trying to take over here, and then there'll be a low probability of a takeover. So what's happened here is that the probability of a takeover is highest when the manager is shirked, and that's the basic idea, and so then that creates this incentive. Sharfstein argues for, well, if you've got that outside threat there, then that can actually give the existing manager the incentive to not shirk in the first place. Okay, so that's what his argument actually is. Now, whether that works in practice, of course, it's an empirical kind of issue, but that's the basic sort of theoretical argument. So again, this is a little theory paper where we have all these ideas from economics coming in and applied to a situation where you wouldn't ordinarily think about it. So we think about moral hazard and incomplete information, and we think, market failure, but actually here's a thing where the private sector is designed, or maybe by accident, or there is some sort of mechanism there that can actually help address that possible source of a market failure, right? Okay, so that's an example of takeovers as a disciplinary device. So just going back to that list, I could give a slide on all of those kind of things. I'm not going to. I've just chosen this one down here to give you a flavour of how that explanation goes. And the literature on this is huge. Every one of these issues is massive. So I'm not going to claim today to give you a comprehensive overview of all of these things. So what I want to do instead is just take you through some other economic issues that people have looked at in this space, and give you just a flavour of how powerful economics is and how widespread the tools that you may have used before can be applied. So what I'm going to talk about is just a little bit of bargaining theory and negotiated mergers. So this is a situation where it's a so-called friendly merger where the managers from each company get together and just nut out a deal. Okay? But then there's other situations where a rater might come in and say, well, I'm just offering shareholders, making them some offer, and I don't care what existing management thinks. Right? So you're making a direct sort of public offer. So I'm going to talk about that and then see how free riding can come in there and then the solutions to that. Then we'll look at a bit of auction theory. And if you think about it, well, the idea of a takeover or acquisition is right for an application of auction theory, because all we're doing is bidding for an asset of some unknown value, right? And if there's competitors there who are making bids, then that's just like an auction. So if throughout the corporate finance literature, you'll see wide application of auction theory out there. And then if we get time towards the end, I'll talk about shareholder voting and some ideas from economics that have been applied in that area. Okay, so a bit of bargaining theory and negotiated mergers. So as I said, friendly negotiated merger, the bidder and target management get together and they bargain over the terms of the transfer, and the key question is, well, how much are you going to pay existing shareholders? And so this naturally leads us to an application of the economics of bargaining. And in the economic literature, there's two broad approaches. One is the so-called non-cooperative bargaining approach. And the basic idea here is we think about negotiation just as a strategic game that could possibly go on forever. So I make an offer, you make a counter offer, I make a counter offer, and we keep going like that. But we discount the future. So I value today more than tomorrow, so it's in my interests, both of our interests, to try to get a deal today, right? But on the other hand, we could be risk averse as well, and so that influences how willing we are to make a deal that we, if we were less risk averse, we mightn't want to do that. So there's all these aspects that come into it. And so the typical outcome, and then there's outside options as well. So you could get an offer from somebody else, could come in while you're negotiating, and all these nuances. So the literature on non-cooperative bargaining is huge. And typically, though, what happens is that parties agree straight away, right, because of this discounting. But the extent to which the benefits are shared between them depends on all those parameters I just talked about. So if you're very risk averse, you're willing to accept a very low share. If you highly discount the future, you're willing to give up a lot today just so you can avoid having these big losses later on. If you think there's a high probability of an outside option, then you might be willing to hold off. All of these kinds of things influence the outcome. So that's the non-cooperative bargaining approach. On the other hand, there's the cooperative bargaining approach, which just says, well, let's just think about a set of rules or axioms which seem reasonable for splitting the value of some surplus. Okay, so one simple axiom is I'm not going to accept anything that makes me worse off, right, than I already am in expected terms. So that's a simple, straight away that places some bounds on what we think the outcome will be. So this axiomatic approach was actually due to John Nash way back in the 50s, and also, of course, Nash contributed to the non-cooperative game theory approach as well. So usually it's the first one that we associate with Nash, but actually there's a whole other set of literature on cooperative game theory, which is also due to John Nash. And if you think about it, well, these two approaches seem completely different. One is we're sort of haggling over the size of a pie, and could get, we could make threats and all sorts of things depending on what the rules of the game look like. The other one is, well, there's just these sets of axioms that somebody invents, like a court just says, well, here's a set of criteria which I want you to obey when you come up with an agreement, and the agreement's got to obey those rules. Okay. But it turns out actually that there's very close links between those two approaches. In particular, under the non-cooperative approach, if you assume that the time period between offers and counter-offers goes to 0, so we're rapidly firing these offers and counter-offers at each other, then it turns out that the outcome under that non-cooperative approach is exactly the same as what you get under the cooperative approach. Right, so that's in a really interesting paper by Binmore and others, and it's one of the most sort of remarkable results is that these two different approaches under different circumstances give you the same prediction about what will happen. Again, this is a huge literature, but you can see how it's naturally then set up to think about mergers and acquisitions and takeovers, and how, in particular, how the gains from any such merger might be split between the target and the acquirer. So here's just a picture, of the situation. So here we've got the payoff to an acquirer. They've got some disagreement point here, and this just comes about and saying, well, they're not going to accept anything less than that. And then the target has the same thing up here. They have a disagreement point that's here. They could get all of the surplus, which is this joint value, or the acquirer could get all of the surplus as well. But in this L-shaped thing here, that's the set of possible agreements that they could come to. And so all of these approaches to bargaining theory do is just pick out a point in that set. Okay, now I've just put a point here which looks like it's sort of splitting the surplus evenly. That could be an outcome depending on what you assume about all of those things that I talked about before. But then you could get other outcomes depending on whether you take the axiomatic approach and what axioms you place on the bargaining that's happening, or if you take the non-cooperative approach that says, we're going to have this offer and acceptance game, and you'll accept more or less depending on how risk averse you are and everything else. So the basic theory of bargaining is just that picture, in essence, but obviously it's a lot more complex than that. And if you try to read some of those papers, you just find it impossible because they're very technical. So I've given you just a very quick helicopter tour of how that theory is used to predict in theory of mergers and acquisitions, just one aspect of it, which is just the way in which those gains can be split. And of course, the way in which the gains can be split, if we think about that sort of rolling back one period, then that will determine my actions before a merger or acquisition happens. So if I'm a shareholder and I think, well, if a takeover offer comes along and I'm only going to get 10% of the surplus, then maybe I'll do something today to either try to make that higher, or I'll get out. And so the point here is that these bargaining norms or bargaining outcomes can have real effect. It's not just a matter of splitting up a pie that's already there. It can influence the size of the pie ultimately as well. Okay, so that's just a quick little primer, if you like, on the economics of bargaining and how it can be used. So another issue that comes up when we're talking about going from the negotiated sort of view of the world to the public tender offer view of the world is this idea of free riding. So this is another instance where some basic economic issues that you would have learned about really come to the fore and influence how some rules around takeovers apply and how the managerial shareholder contract is actually written to try to get around some of these free riding issues and deal with it. And so you can see, often you see, well, there's these rules around, well, what happens if there's a takeover in the constitution of a company? You think, well, why would they do that? Well, there could be efficiency reasons for why that happens, and so we'll see that. Could be inefficient as well or completely silly, but in some instances there's good efficiency reasons for it. Okay, so what we're looking at here is a situation where an acquirer makes a take it or leave it tender offer, and suppose we've got this person is so-called raider who just has superior management skills, and they'd fire the current team and increase the value of the company per share to V. If they are, but what the one rule they've got to obey here is they've got to own at least 50% of the shares. Okay, so V here is the value of a share if the takeover is successful. PS is the current value of a share, and we're going to assume that V is greater than PS. So what the raider could do is to say, okay, well, I'll offer you existing shareholders P sub R, which is not quite equal to the value of the company if I'm successful, but it's better than what you're currently getting. Okay. Now, efficiency here says, well, the value of the company is increasing, so we want this takeover to go ahead. We want that to happen. And shareholders here just have a simple decision. I either tender my shares, so I sell them at that price, or I just hold on to them and wait, okay, to see if the takeover is successful or not. So if these shareholders are very small, so if we think about sort of competitive market assumptions is that all consumers are very small and all firms are very small. Here's a situation where we're assuming individual shareholders are very small. Then the issue here is that each shareholder's decision whether to sell or not just has a minuscule effect on the outcome. It doesn't matter whether I sell my one share in Aurizon, so whether they're going to be taken over by somebody or not, because I have no influence on the outcome, unless I'm pivotal, right? Unless I'm pivotal. But under this assumption that we've got very many small shareholders, the probability that I'll affect the outcome is zero, right? So if that's the case, then well, if I tender my shares, why would I sell them at a price of PR? If I think the takeover is going to succeed, why would I sell them at this price PR when I know that if the takeover succeeds, I could get V later on? I'll just free ride off everybody else's decision, and you sell your shares at PR. I'm waiting because I'm going to get V, which is bigger. Right? Well, if everybody thinks like that, then the takeover is not going to happen. Right? And so we get a classic sort of free riding kind of situation. So this is this paper by Grossman and Hart in 1980. And so they argue that the takeover bid will fail and the potential welfare gain here won't be realised just because we've got this assumption here that small shareholders, none of them are pivotal. Each shareholder has a negligible effect on the probability that the takeover succeeds. The only way it could succeed is if the raider offered a price higher than V, but why would they do that? Because then the things are only worth V once I take over, so I'd never offer anything bigger than that. So we sort of reached this impasse, and Grossman and Hart pointed out that, well, takeovers, if they're efficient, aren't going to happen in that situation. So the question is, well, we want takeover to happen in that situation. What can we do about it if we're the shareholders? What can we do about it? Well, one possibility is that, well, we could have large shareholders, right? And with a large shareholder, now the probability that they're pivotal could be quite high. Okay. Bagnoli, I don't have it listed here, but Bagnoli and Lippmann, in a direct reply to Grossman and Hart, said, well, hang on, some people know that they're going to affect the outcome because there's these large shareholders, and they know that there's some probability they're going to be pivotal. So let's take a simple example of how that can work. So I suppose we've got 3 shareholders, let's call them A, B and C. For convenience, let's suppose they own 1 share each, and the rater's got to get 50%, so he's got to convince 2 of them to sell their shares. Okay, at least 2 of them. And so what we're going to look at now is, in the literature, is known as mixed strategies. So a mixed strategy is just a probabilistic choice over my strategy. So if I'm a shareholder here, I might decide to sell with some probability, say 10%, and decide not to sell with probably 90%. That's all a mixed strategy is. Okay? But to be able to want to do that, the expected payoff from randomising in that way, if you're a shareholder, turns out has to be equal to the expected payoff from not doing that. Okay? Otherwise, you would change your probability distribution to make that happen. So what we can do then is to, I won't go through this, this is some algebra. You can work out the expected payoff from tendering a share. It's a function of the probability that I tender and the value if the takeover goes ahead, and then this other expression again, which depends on those probabilities and the price of the current share. And it looks like this. All right, so this just says, that's my payoff. If I decide to tender, this is the thing I get from not tendering. And so it's got to be that there's some probability there which make those 2 things equal, and that's the probability that I'll choose if I'm a large shareholder here. And it depends on the number of other shareholders there are out there, the value of the firm, if the takeover goes ahead, the current share price, all of those things. Okay. So the rater then looks at this and says, okay, well, there's 2 things I can do here. I could sort of increase my price that I'm paying to these shareholders, and that would increase the probability that they'll actually sell it to me. But increasing my price, I'm reducing my profit. So there's a trade-off. It's like you're a monopolist here. I could lower my price and get more consumers, but I could lower my profit in doing so. So I've got to reach some point where I'm maximising my profit. And so the profit here to the rater looks like this as a function of the probability of tendering. So this is just in this example with 3 shareholders. So you can go ahead and compute what that looks like. And there's a maximum point here. So that's that point at which that marginal revenue equals marginal cost, where that trade-off is optimised. But the interesting thing about that is that point there actually maximises the probability that each individual shareholder is pivotal. Right? So what has happened here is by randomising in this way and by offering this price that maximises profit, the rater has actually maximised the probability that each shareholder is pivotal. And intuitively, that makes sense, because what you want to do is get in their minds that, well, I really am going to have an effect here on the outcome. I'm willing to sell at a reasonable price. It turns out that those 2 things exactly coincide, and that's the thing that maximises the rater's profit here. Okay. Now, the only problem with that is it's still not 100% probability. It's 2/3 in this example, and that probability gets smaller as the number of shareholders increases, and it goes to 0 as you get many, many shareholders. Right? So that's just an example of how, again, we've taken a simple idea from game theory, which is this idea of mixed strategies, and applied it to this situation with large shareholders, and you can then get a prediction from that about, well, what's the price that the rater will pay, what's the probability that the takeover will be successful, what's the probability that each shareholder will tender. All of these things fall out of that. So it's a really powerful set of tools that you can use. But Bagnoli and Lippmann, their main sort of purpose of writing that paper was just to say, look, Grossman Hart, you're wrong, because there's large shareholders out there. and we don't get that pure free riding. Although it's not completely efficient, it's not as bad as what we think it is. So that's one way out, is to have these large institutional shareholders who are pivotal, and that can work in favour of efficiency. Another possibility is voluntary dilution of minority shareholders. So dilution occurs when the rater reduces the value of the company by a certain amount and is permitted to pay that difference to himself. So you might pay yourself a large salary or issue a large number of shares to yourself, these kinds of things, right? And so Grossman and Hart in the same paper, they argue, well, one way around the free riding issue is to actually, for shareholders in their constitution, when they're setting up the company, is to, well, let's allow for this dilution to happen if a takeover goes ahead. So why can that work here? Well, if we think that the value of a share after the takeover is V, and shareholders have agreed some dilution factor phi, then if I tender my shares now, I'll either get PR, so that's the price that's offered to me, or if I don't, I wait around, I don't get V now, I get V minus whatever the dilution factor is, right? So now if the company takes over, if the rater takes over, the whole value of the company is going to increase, but my share of it is going to be a lot less than what it was before. And you can see now, well, if that fee is set high enough, then this thing is going to be less than the price that I'm offered today. And so now I'm going to say, well, I'm going to sell now because I know if the takeover is successful, I'm not going to get the full amount of V, I'm going to get something else that's less than that. Right? And I'm happy for that to happen as long as this, this amount here, and I'm willing to tender my shares as long as that amount there is still greater than the current share price today, okay, which is PS, which we had up there before. So there's some simple economics there that says, well, maybe there's an efficiency reason for this dilution. Maybe there's other reasons as well, all right? But there's possibility that this could actually have some efficiency justification. This voluntary dilution of property rights increases the probability that we get the outcome that we want. And that was Grossman and Hart's other argument in their paper. So what we're really talking about here is economics of property rights, where you've got I call it overlapping disposal rights, where the fact that I sell part of the asset has an effect on you. So we're creating either a negative externality or a positive externality. If there's just a single owner, that issue never arises. I just sell it, and I might have external effects on somebody else, but I'm not affecting the other owners. But here's a situation where, because we've got multiple owners, what I do with my shares could potentially affect your value. And so you think, well, ordinarily we think externality is some sort of market failure, but companies deal with this all the time by designing these mechanisms to try to deal with this. Okay, so that's a bit on dilution. So just to summarise that little section, we're talking about the economics of overlapping sort of disposal rights. When we've got a public tender offer, we want the takeover to go ahead. We think, well, if there's small shareholders, there could be free riding. There's different solutions to that. And I've only gone through 2 solutions, but there could be many others. So there could be ways in which the offer is actually constructed. So you give tiers of offers. So you get 20% on board first by offering them some price, and the promise of higher benefits later on, and then you make tiered offers to existing shareholders. There's all sorts of things that are examined in the literature to try to get around this free riding issue. Okay, so takeovers and the winner's curse. So now we're moving from the sort of the situation where we're trying to get shareholders on board and sell their shares, to the situation where, okay, we've taken control, and often it turns out that the value of what we bought is not what we thought it would be. And you often hear this in practice, people, and there's some really good examples where people buy a company, turns out to be a dog, and everyone thought, well, we did the due diligence. Why did that happen? You know? And so one possible explanation that people talk about could be the winner's curse. So I'll just take you through that. It's a bit of auction theory here, and to show you how that could work and why it may not be such a great explanation. So why does this, this tendency sometimes for us to pay too much for a target happen? Well, we're going to say that it could be an example of winner's curse, and people often talk about this. And this arises in a whole lot of situations. So one particular example that I've seen is when companies are bidding to construct toll roads. Right? So you construct a toll road in Queensland. We think traffic forecast is going to be 100,000 a day. Turns out to be 20,000. We get taken to court. The economic consultants get sued. Everyone gets into trouble, and people say, "Well, it was just the winner's curse. We just bid for something where we thought the value was high, and actually turned out to be not so high." And so there's actually a significant literature on this. So there's an application to takeovers as well. So suppose we've got two bidders here. Let's call them A and B. And they're doing this due diligence on the value of a target. And when you do that, what you're really getting is a signal about the true value. And you're not going to get the answer. You might sort of narrow down what you expect the value to be, but you're not going to get a perfect prediction of what the so-called true value is. All right, so let's suppose that there's a low signal that you could get, and the company you think then, after you've done the due diligence, is only worth 9 billion, or it could be 11 billion, and they happen with equal probabilities. And each bidder here gets that signal. Right? So we go out and do our due diligence, and there's lots of possibilities that could happen here. We could both get a high signal. One of us could get high, the other one could get low, or we could both get low. Right? So the question is then, well, how does that influence how much we bid for the company? Well, let's suppose the true value is just the average of those signals. And suppose that each bidder just employs this simple strategy. I just bid the signal that I get. So if I get a signal from my due diligence that says company's worth 11 billion, I'm just going to say 11 billion. That's going to be my bid. Right? So what happens? Well, if we both get a signal of 11 billion, the average true value then is 11 billion. We each win with, say, probability 50%, but the true value is 11. We both bid 11, so we're not going to get any value out of that. Okay. On the other hand, if I get a high signal and you get a low signal, then the true value is 10. Okay, but I've bid 11, so I'm going to win. I've bid $11 billion for something that's only worth 10. I'm going to make a loss of 1. Right? And same over here. And if we both get this low signal, and in that case, the true value is still 9. We both bid 9. We each get nothing out of it. So the problem with undertaking that strategy is if I weight each of those cells with the probability that that will happen, I get that minus should be, so it's minus 0.25, and so I end up getting a very bad outcome there. And so the basic idea is the winner's curse is, imagine you're taking a draw from some distribution in this room, and I tell the person with the highest value of that draw, you have to pay me that amount of dollars for this pointer, right? Well, inevitably, if I make the distribution wide enough, there could be someone who gets a draw that says $1,000, and under this rule, they have to pay me $1,000, right? And they get this, but it's not worth $1,000, right? And so that's the winner's curse. I haven't taken into account the fact that actually the true value of this, just by the fact that I've got a random draw here of valuations, somebody's going to have something really high. And the true value is something less than that, but if you bid your signal, you're going to pay too much, right? So that's the winner's curse. And if we think about it, it can't really arise in equilibrium, because if you're rational, you'll know that, well, there's a chance here I could have I don't know what draw Tim's got, but there's a chance that his could be lower than mine and I could have the highest one. So I want to just reduce my bid by a little bit. If I get the draw of $1,000, I'm not going to say, bingo. I'm going to say, well, $1,000, it's a pretty high likelihood that I've got the extreme of the distribution. I want to cut it back a bit. Okay. And we haven't got time, I won't go through the slides, but what you can show is actually that a safer strategy, in this case of just bidding, if you get the high signal, the average value, and if you get the low signal, just bid the low value, that actually gives you a positive payoff here. So what you want to do in this situation is just, if you get a high signal, just reduce it by a bit, right? And then you don't get the winner's curse, because you might still win. You might still get an object where you thought the value was a lot higher, but you won't have paid too much for it, right? So that can still happen here. You could still get a situation where we actually privately thought this thing was worth a lot of money. We didn't bid that amount because that would have been silly, but we still ended up with something that we're disappointed because we got something that was not worth as much as we thought, but at least we didn't pay so much money for it. Okay, but that's a different version of the winner's curse. It's not one that matters so much for the financial bottom line. So the issue here is then, well, if we've got rational bidders, then that pure winner's curse kind of idea shouldn't happen in equilibrium. People have done experiments, though, and it turns out that it does happen in these experiments. So the puzzle is then why does that occur? And then in the real world, of course, we all know that people are nodding their heads that yes, that can happen. So I don't know why. We don't know why that's the case. But there's a little example there to show you, how that works. Okay. So that's a little bit on the winner's curse and this phenomenon where people in takeover or merger can sometimes pay too much for the target company. What I wanted to talk finally about is some topics in shareholder voting. So voting's one of my favourite topics, and I do a course at Griffith where we look at the economics of voting and we apply it to government decisions and elections and things like this, but it actually has a whole bunch of applications in corporate finance, and the literature has looked at all of these applications and really just carried over a lot of the insights from public choice and social choice and those kinds of ideas. So one issue that comes up in the corporate finance literature is how should we align a person's right to dividend streams, if they're a shareholder, to their voting rights. Okay. So this is this question of one share, one vote. If I own a share, do I have full voting rights, or should I have something less or more? What should that arrangement look like? And another question is, well, does it even matter? Who cares what these voting arrangements look like? Does it really matter? So Grossman and Hart, again, same authors, different paper, argue that, well, actually, there's a good reason why you might want to have one share, one vote rule, and it protects shareholder property rights. And so they use the following example to illustrate that proposition. So here's the example. Suppose we've got two classes of shares. One is Class A, and they've got all of the voting rights, so 100%, but 50% of the right to 50% of the dividends. And there's another class of shareholders, the B class, who have no voting rights, but they still get some of the dividend stream. Okay. So here we've just set up a situation where there's a discrepancy between the rights that I've got to the dividends and the right I've got to vote over the direction of the company and what its managers and so on are going to do. So why does that matter? Well, let's take a look at a corporate takeover where we've got a raider coming in who's actually inefficient. So we don't want this takeover to go ahead. So let's suppose that the value of all shares is 200 at the moment, and a raider wants to come in and the value is only going to be 180 if they take over. So we don't want this to go ahead. But it turns out that if there's some private benefits of corporate control combined with this shareholder voting arrangement, that takeover can actually go ahead when we don't want it And it turns out if you move the voting arrangement more towards one share, one vote, it doesn't happen. Okay, so that's Grossman and Hart's argument to say, well, this is a reason why you might want to have one share, one vote. All right, so what happens here? Suppose that the Raider makes an offer to buy Class A shares for $101. Well, Class A owners will definitely sell, since if they don't, they'll only receive $100 if the Raider fails and $90 if it succeeds. Remember, they own 50% here. So somebody offers them $101, they're going to sell. But now what's happened is, well, they've got all the voting rights. So the Raider just takes over and determines what's going to happen with the company. And so he's going to reduce the value to 180. Okay. So what I've done then by selling my shares, if I'm the Class A owners, I've imposed this negative externality on these poor old Class B shareholders who've gone from having a value of $100 to having a value of 50% of 180 or $90. Now the Raider has made a loss here. He's paid $101 for shares that are only worth 90 once he's taken over. But if he gets $12 in some private benefits, maybe someone's going to pay him a salary or he just likes, building an empire or whatever it is, then he's going to say, well, that's worth it. I'm going to take the financial loss of 11. I've got this other benefit of 12 out there. It's going to happen. So this combination of this voting arrangement and the existence of these private benefits, the takeover will go ahead, but we've destroyed the value of part of the value of the company. Okay. Well, what happens now if I just change the voting structure? So now let's suppose that Class A shares only have a claim to 75% of the firm's dividends. So they're now only worth, those shares are now worth $150 under the incumbent. Okay. So now what we're doing is aligning the voting rights with the rights to the dividend. So they were worth 50, now they're worth 75. A's still got 100% of the voting rights. Okay. What happens now is, well, the Raider could still offer, say, $101, but that's going to be rejected because now the shares are going to be worth 150 under the incumbent, so you've got to pay me 151. So you've got to pay me a lot more now because my rights to the dividend stream are now more in line with my voting rights. Well, you could pay these Class A shareholders $151. Again, you'd still get an external cost imposed on the Class B shareholders, but now that externality is a lot smaller and the total value of the company is only going to fall from 200 to 196. And the Raider's loss is now higher because now he's paid a lot more he's been forced to pay a lot more for these shares which have a higher dividend share attached to them. And if his private benefits are only 12, he's not going to find that to be in his interests. Okay, so what's happened here is by forcing the Raider to pay a lot more, and you force them to pay a lot more because now that these Class A shares are more aligned with the voting rights, then that takeover won't be as likely to go ahead. And so what's happened here is that we've got to move from one share, one vote, sort of corporate governance arrangement towards that, and it's enhanced the security of shareholder property rights by reducing that possibility of value-reducing takeovers. And so Grossman and Hart argue that, well, that's one efficiency reason why we might want to have one share, one vote. Okay. Now, there could be other reasons where you don't want to have that, but they say, well, if you want a takeover not to go ahead when it's inefficient, that's one way of doing it, is to have that sort of institutional arrangement in place. Okay, so the way in which shareholders' voting rights are set up, you can see there's potential for it to matter for efficiency, okay, economic efficiency. One final topic, and I'll just spend a few minutes on this. I think I've got a bit of time. One final issue that I'll talk about is this idea of shareholder voting power. So we talked before about large shareholders and the extent to which they're pivotal. This is taking this a step further and saying, well, now it's not pivotal when you sell your shares, it's looking at the power that you have just when you're voting as a shareholder. And you're a large investor, how can we quantify that degree of influence you have over a company's decisions? And so that's this idea of voting power. So again, the concept of pivotalness is again critical. And so what happens in the literature is they look at this concept of voting power, and formally that's the likelihood that a shareholder will influence the outcome of a particular motion. So if you can purchase shares which have voting rights attached to them and you've got a large enough stake that you're going to be influential, it could turn out that, well, there could be some portion of that which you're willing to pay a greater amount for. So it not only matters for, well, the direction of the company, but it could also affect the price of shares in some circumstances. This is why this matters. So here's a little example to illustrate this concept of voting power. Suppose you've got 36 voting shares and 3 shareholders, and A owns 11 shares, B owns 17 shares, and C owns 18 shares. The percentages of shares are here, and it looks as though, well, B has got the most shares, so he should have, looks like he should have the most voting power, right? But if you need a majority of shares to get a motion passed, that's not quite right, because he's only got 17. He's going to need the support of at least one of these other shareholders to get the motion that he wants through, okay? Because you need at least 19 here and 18 to defeat any proposal, okay? So what we have to do to work out what's going to happen here is to work out, well, what are the winning coalitions? Well, the winning coalitions here are just, A and B could vote together, they could get something up, or we could reverse the order, B and A, or it could be C and A, or any combination of the pairs, as well as all of them could vote together. So the idea of shareholder voting power is just to say, well, what's the frequency in all of those arrangements that you affect the outcome? Right, so with 3 shareholders, it's easy. All I have to do is work out, well, when are you pivotal? Might be, say, 10 occasions. How many possible ways are there in which we could all vote? It might be 100, and so I'm influential 10% of the time. That's my voting power, okay? So it's not going to be just a raw number of shares computation. It's going to be, when am I going to make a difference? And that depends on the amount of shares that other people have, as well as the shares that I have. I could be a very small shareholder, but I could be very pivotal, right? Just depending on, think about Clive Palmer in the Senate, right? Or he used to be, okay, until recently, right? Or, the Greens, right? The Greens are very powerful. They only have like 9 seats, but they still have a voting power that's in excess of that. So this is the same idea. All we're doing here is now taking some economics of social choice and applying it to shareholder context. So if you look at the numbers here, just go back to that table, well, no one really has any higher influence than the other. It's still the case that, if B wants to, he's big and nasty, but he still needs to get either C or A on board for something to happen, okay? But C's in the same position. If he gets one of these other shareholders, then it's the same thing happens. So here, a natural measure of voting power should say everyone's got equal voting power, so 33%. That's what it should be, okay? And so what the Shapley-Shubik index of voting power does, it just formalises. It says your voting power of shareholder I is the number of arrangements in which you're pivotal divided by the number of all possible arrangements. Okay, so it's just the expected frequency with which you're pivotal. Now in this example, it's really easy to work out. More complex examples, it's impossible, but people still have tried to do it. There's some math there I won't go through, but in this example, the Shapley-Shubik index is just simply a third for each shareholder, and it's not, this point is it's not the same as the raw number of shares. Okay. So that's again, Shapley, I think he won the Nobel Prize a few years ago, and this was one of the pieces of work. He applied it in a completely different contexts, which was voting in a deliberative committee, but it turns out it has applications in corporate finance as well. Okay, so that's a little bit on applications of voting theory to these kinds of things, and this can matter. If you're thinking about propositions to change the corporate constitution, which again affects the probability of a takeover, the distribution of voting rights will matter. So hopefully I've given you, a bit of a flavour about all the applications, or some of the applications of economics here to all of these kinds of issues. Now I haven't touched on competition policy issues, issues around vertical integration, market power. That's another sort of topic. This is more focused on the interaction between economics and corporate finance, but maybe next year you can get someone to talk about competition policy. But obviously that's there's a lot of important issues there as well, and often that will determine whether a takeover is successful, just whether the policy authorities allow it to go ahead or not. So that's just by way of conclusion, a bit of a helicopter tour of some really interesting issues, I think, in economics and applying them to corporate finance.
Well, thanks, Alex.
Yep.
We've got a good time for questions now, so please.
Alex,
Yep.
in the first example you talked about free riders, but
Yep.
I think in practice free riders are free soldiers.
Right.
And I'll just give you a hypothetical
Yep.
example. Let's think of an entirely imaginary corporate raider, let's call him Carl.
Yeah.
Okay? And let's think of an entirely imaginary corporation, let's call it Apple.
Yep.
And Carl Icahn discovers that Apple has a whole lot of cash.
Yep.
It's probably got more treasury securities than the Federal Reserve, something
Yeah.
like that, I think was the number.
Yeah.
And he comes to the view that if they use that cash to buy back stock, the stock price would go up a long way.
Yep.
So, what he does is he takes a small initial position in
Yeah.
stock. He also has about 10 times as many call options
Yep.
when he takes that initial position.
Yep.
He then announces to the public that he's taken that position.
Yep.
And because he has a reputation as a not a corporate raider, that's a dirty word now.
Yep.
Now he's a shareholder activist.
Yep.
People in the
Yeah.
market know that when he gets involved, he will drive up the price.
Yep.
So these people then come in for free, these free soldiers in the market come in and drive up the stock
Yep.
in response to the announcement he's there. So
Yep.
in fact, instead of there being
Yep.
free riders, which
Yeah.
are making it more expensive,
Yep.
they are free soldiers, which
Yeah.
are making his entry relatively cheaper.
Yeah. So it could go the other way. Yeah.
It
yeah.
does go
yeah.
the other way
Yeah.
once, once he announces what he's doing, because other
Yeah.
people pile in and buy the stock.
Yeah.
And then what eventually happens is Apple is provoked to use its cash to do the stock buyback,
Yep.
to make him go away. The share price goes up, he sells his stock, he leaves having achieved another triumphal day
Yeah.
of shareholder
Yeah.
activism
Yeah.
and being
Yeah.
a good guy.
Yeah.
But in that circumstance, what I'm saying is, I think the free riders become free soldiers in real
But
life.
have we got the optimal outcome still? I mean,
What's the optimal outcome?
well, I don't know. I'm asking.
Walk away with an extra $1
Yeah.
billion.
So is that good?
What else does he want?
No, but is that a? So the point of Grossman and Hart's paper was that you can get, something's value enhancing doesn't happen. So what do we want to happen in your
Well,
case? I'm just trying to.
What actually happened is he's delivered to the free soldiers because he forced Apple to buy back this stock
Right.
and push up the price.
Okay. Yeah.
And
All right.
Apple can still get by with half of the amount of cash of the Federal Reserve instead of more cash in the
Yeah.
Federal Reserve.
Yeah. Yeah. No, I agree. It can go in the opposite way. Yeah.
It sounds like a perfect outcome.
Yeah.
It does.
Yeah.
But that was an imaginary example.
Yeah. Yeah.
We get the money back to the shareholders rather than sitting on a balance sheet.
Yeah.
So if you've got
Yeah.
an organisation sort of now it's becoming fat and happy,
Yeah.
money back.
Yeah. Yeah. So I'm not claiming that the existence of free riders always leads to the suboptimal. I'm just saying there is this. Grossman Hart identified this situation where that could be a problem, right? But it could be they don't claim that it's always a problem either. It's just saying, well, this is a situation where if you're trying to take over, and that's what we want to happen, it could the existence of those people could defeat the purpose. But by the same token, it could, in a different circumstance, could give you the outcome that you want, that we want. So,
Is there a disbenefit associated with your example? I wonder, because at face value, it seems like everyone's a winner.
yeah,
But I'm just wondering, what's the cost of pushing up, like, the price of something compared to what the true value really was? Or, does that distort the market in some way? In your example?
Well, true value is what the market
Well,
decides
that's
what
right,
true
but,
value should be.
yeah,
I mean,
exactly, but it's been manipulated by a particular individual in a short period of time, so. is
Well,
it
it's been
true
interacted
policy?
with by a particular individual. It was not a bad thing. I mean, did Apple actually need all that cash?
Yeah.
yeah,
Oh, yeah, no,
yeah,
I mean, that's not a problem.
yeah.
Treasury,
But there is a literature on so-called toeholes as well with this. That, one way of overcoming the free road problem is to accumulate some fraction of shares yourself, and then, but that could lead, as you say, to some suboptimal outcomes in some cases, or positive outcomes if there's these free riders. So, yeah, it doesn't all go in one direction. So, yeah.
Well, isn't that kind of the same idea behind the winner's curse, in that, in many respects, it's in the interest of individuals that are taking part in the transaction to actually have the suboptimal outcome. And actually, kind of the example that you identified, like Clem 7, everyone was working basically in that project, feasibility studies, the engineers and banks,
Yeah.
to actually overvalue that project,
Yeah.
so that the investor would specifically lose.
So, and why is that good?
Well, because it's not, but it's not good, but that's where that comes from. So
Yeah.
it's not that people are making irrational decisions. The investors are making rational decisions based on false information.
So then it's not an example of the winner's curse, and it's something else. It's just that their incentives are structured, in such a way as you've got an incentive just to get to not take due care, and so that's not the pure winner's curse. And that's pure winner's curse is I just get a signal. I don't really care what it is, but I just bid the signal. I think what you're saying is I've deliberately created a high signal to get a particular outcome for myself, and then stuff the consequences.
People are providing you the signal. You're not making the signal.
Yeah.
yourself.
Yeah,
So for you,
Yeah.
it is the winner's curse, but for everyone
Right.
else, everyone else cursed you.
yeah, yeah,
But isn't
Yeah.
this, so this was my question actually for you, and first of all, thank you for a great presentation. I think it's been really informative. But with the winner's curse example, so the only way for you as an investor to avoid that, because say the signal isn't that high, say it's, quite close
Yeah.
to what the true value is, the only way that you're gonna be able to avoid that impact is to undertake multiple signaling exercises. So you're
Yeah.
gonna get not just one due diligence signal, but say 3.
Assuming-
Cost associated with that.
and assuming they're not all correlated with each other.
That's right.
You don't want to go around to the big four and they tell you all the same thing.
There's due diligence, cost, and probability that can help you sort of avoid that outcome.
Yeah. Well, that's one for the end. So you've got the possibility that, everyone's sampling from the same distribution in the same way, and you get,
There's only so many
you-
consultants.
and then just the financial cost of doing it. Yeah.
That's right.
Yeah. Or you can make some judgment about, well, here's what we think the underlying sort of probability distribution is here, and just cut your bid back optimally a little bit. That's what the auction literature says. That's what you should do. But it depends.
Yeah.
That amount that you underbid depends on your assumptions about all those other things. So, yeah.
So just got a question
Yeah.
about devolving an asset. So you
Yeah.
want to sell something and
Yeah.
you've got to convince all the shareholders that it's a good idea to sell it.
Yeah.
Do you work with anyone who wants
Thanks, Mark. Doing so, using that framework of the minimum value and the probability of the sale, is that
Yeah.
still working with
Yeah, I think it would. So now it's just you're the seller and somebody else out there is a buyer. But now that, you know, the strategic analysis of this was coming from the buyer's perspective, whereas you're really thinking from the seller's perspective, and maybe you know, there's a slight twist on it. If you're a buyer, certainly, you know, it's the same analysis, right? You don't want to pay too much for something. But now if you're the seller, you might think strategically about, well, how can I, you know, I want the winner's curse, right? I want people to pay me a lot of money. And so that's, yeah, it's going to be different from that perspective, yeah. So then, you know, the way in which you design the auction is going to, you know, potentially matter. Do you have a minimum, you know, reserve price? How many bidders do you let in? That all matters. Do I have first price auction, second price auction, open, you know, increasing bids, decreasing bids? What do I do? And those things can all. Yeah. So I haven't read anything on, you know, sort of maximising the minute winner's curse specifically, but yeah, it sounds like it would be an interesting thing to think about. Yeah. Yeah.
Yeah. Are you aware of much research in mergers and acquisitions of non-profits? Because I know generally the non-profit economic sphere is a bit scanty, but
yeah. No, not really. I've had one of the students in my class, not you guys, but last semester we did something on taxation of non-profits. But yeah, I haven't really thought about mergers and acquisitions. So yeah, it's interesting.
You do wonder whether you had a list of sort of neoclassical
Yeah.
reasons for mergers
Yeah.
and acquisitions. And I think anecdotally, what seems to be fairly important is the managerial ones, which I think are relevant in the not-for-profit space, where you know the remuneration of the CEO is sort of correlated with the size of the company, and there were perhaps still are these remuneration models that add another dimension if there's a global analysis. So for a CEO to get higher pay, big is good, bigger overseas is much better, and you do wonder why why we're seeing so many failed overseas expansions and takeovers by Australian companies. And I expect some of those things play out in the not-for-profit space as well, where market signals aren't very strong, but you know, scale kind of matters.
Yeah, and also, I mean, who are the shareholders? Who are the and they're not, you know, they're not maximising profit. You're maximising something else.
Yes.
It might be scale or whatever it is. So
Maximising the benefits of the employees.
yeah.
Can you go back to your slide? I think
Yeah.
it was slide 8, 9 or 10 or something, where you had all those motivations. I mean,
Yeah.
you get a pretty good fix on those. Because I mean, you know, my sort of,
Oops.
you know,
Oops, there's a train.
What have I done here?
yes.
Is it a free advertising?
Yeah. Well,
It's purely accidental.
I should acknowledge that these sessions only occur for good support from Deloitte, so thank you very much.
But, you know, I mean, I know when we sort of we go through each of those individually and then the other market views, I mean, in the string of transactions I've been involved in the energy sector, it's never one.
Right.
There's always
Yeah.
a bunch of them, you know, so tax is always pretty important.
Yeah.
You're sitting in there somewhere because there'll be a tax loss and you can reduce
Yeah.
it, pops up the value you can pay.
Yeah.
And there'll always be some debt and equity considerations, but
Yeah.
you're fundamentally going towards sort of, you know, it'll be an economies issue and a synergies and a transaction costing. They're the ones that drive it most.
Yeah.
And I'm guessing that with NGOs, it wouldn't be sort of too dissimilar, you know, in terms of they'd be thinking about risk diversification be a big driver because they're constantly on, you know, on a funding risk, and then getting economies of because there must be, you know, sort of a dreadful amount of common fixed costs amongst those sort of organisations, and if they really want to sort of maximise their effectiveness, which in itself sort of diversifies their risk, if they seem to be good at what they're doing, they're lowering the risk, that it'll be that scale thing, and the scope would be a big driver, I would expect.
Yeah.
I guess it comes back to the question as well, like collaboration and competition. Like in some cases, it's economies of scale by collaborating, but other times there is a healthy element of competition as well.
Yeah.
So,
Okay. Other questions?
Any other questions? Very good.
Hey Alex, sorry, just before we go, how much are we teaching this in the universities now?
In economics, we don't, from my knowledge, we don't do a lot of it. I don't know what they do in the corporate finance courses, but this,
Always opposite in that, so there's still not much in economics courses in the undergrad, so I mean, I know there's virtually nothing on vertical integration.
yeah. I mean, I do a bit of, in micro, I do a bit on vertical integration, but nothing, and economies of scale and so on, but nothing, not as much as I'd like on this sort of stuff. There's just, we don't have the room for it, unfortunately. But I mean, I'd like to. And that's what I'd like to do is, policy implications are important, but in a business school, we want to understand what business does, first and foremost, and then economics has a lot of value to add there, I think. So.
Right.
Okay.
Well, look, come to the time of the evening or afternoon. First, I'd like to thank Deloitte's Access Economics. Again, the collaboration on professional development seminars started in 2012, and it's been a great thing. I'd also like to thank Julian Pierce for putting this together, and James Keating for assistance, and you guys for taking the time to show up. Foremost, I would like to thank Alex Robson for a great presentation. We do have our traditions in the society, and one of the traditions is payment through alcohol. This goes very far back. I won't go into details, but one of our past presidents might. You can see him later.
Was it Barry O'Farrell, was it?
Anyway, thank you very much for an excellent
Yeah,
presentation.
thank you.
And if you'd all put your hands together.
Thanks very much.
Quickly before you guys take off, who's this off?
I don't know.
I just want to draw your attention to some upcoming events. We're kind of getting to the close of the year. And there we go. We have the President's Drinks coming up on the 11th. It's an opportunity for us to get together and celebrate traditions, reflect on the year, and look at the year ahead. Next year, we have a couple of big events. We have Glenn Stevens in June. And we're also talking about collaborating with EPAP on an event perhaps in February.
Yes.
So keep your eyes open, and let's have a safe new year. Thanks.